Problem of non-performing assets in India. Non-performing assets, NPAs, also known as bad loans, are loans or advances given by banks and financial institutions that have stopped generating income for the lender. The problem of NPAs has been a major concern for the Indian banking sector. There are several reasons behind the rise of NPAs in India, including economic factors. Economic downturns and slowdowns can lead to a decrease in business activities, making it difficult for borrowers to repay loans. Lax credit assessment. Inadequate due diligence and lax credit assessment processes by banks can result in lending to borrowers who may not have the capacity to repay loans. Infrastructure bottlenecks. In sectors like infrastructure, projects may face delays and cost overruns, impacting the borrower's ability to service loans. Corporate governance issues. Poor corporate governance practices in borrowing companies can lead to the diversion of funds, affecting their ability to repay loans. Government policies, policy changes, delays in project approvals, and regulatory hurdles can impact the viability of projects and repayment capacity of borrowers. Legal and recovery processes. Lengthy legal procedures and ineffective recovery mechanisms can delay the resolution of NPAs. The Indian government and RBI have taken various measures to address the issue of NPAs, including setting up dedicated platforms for resolution like Insolvency and Bankruptcy Code, IBC, asset reconstruction companies, and stressed asset funds. Non-banking financial companies in India. Non-banking financial companies, NBFCs, are financial institutions that provide banking services without holding a banking license. They are an essential part of the Indian financial system and cater to diverse financial needs. NBFCs play a crucial role in providing credit to segments of the population that may have limited access to traditional banking services. Key characteristics of NBFCs in India. Registration. NBFCs are registered under the Companies Act, 2013, and regulated by the Reserve Bank of India, RBI, under the RBI Act, 1934. Core activities. NBFCs engage in activities such as lending and investments, asset financing, infrastructure financing, and offering various financial products and services. Difference from banks. While NBFCs perform similar functions to banks, they cannot accept demand deposits, like savings and current accounts, and do not form part of the payment and settlement system. NBFC categories. NBFCs in India are classified into deposit-taking NBFCs, NBFCD, which can accept deposits, and non-deposit-taking NBFCs, NBFCND. Regulation. NBFCs need to comply with prudential norms and capital adequacy requirements mandated by the RBI. Financial inclusion in India, need and future, PMJD, payment banks and small banks. Financial inclusion refers to the process of providing access to affordable and appropriate financial products and services to all segments of society, especially the unbanked and underbanked populations. It aims to bring individuals and businesses into the formal financial system and promote economic growth and development. Pradhan Mantri Jan Dhan Yojana, PMJD, launched in 2014, PMJD is a national mission to provide access to financial services to all households in India. The key objectives of PMJD are to ensure financial inclusion, provide basic banking facilities, and encourage savings and investments among the unbanked population. Under this scheme, individuals are offered a zero-balance savings account, a RuPay debit card, and access to various financial services. Payment banks and small banks. As recommended by the Nachiket Mor Committee, the RBI introduced two new types of banks to promote financial inclusion. Payment banks. Payment banks are a new category of banks that can accept deposits, up to a limited amount, and provide payment and remittance services. They are not allowed to provide credit services like loans. Payment banks mainly target unbanked and underbanked areas to increase financial inclusion and enable digital transactions. Small finance banks. Small finance banks are a type of niche bank that primarily serves the unserved and underserved sections of the population, including small farmers, micro and small industries, and other entities. They provide basic banking services, credit, and other financial products tailored to the specific needs of their target customer segments. The future of financial inclusion in India remains promising, with ongoing efforts to leverage technology and innovative approaches to reach remote areas and underserved communities. Increased digitalization, mobile banking, and the use of Aadhaar, a unique identification system, have facilitated progress in expanding financial services to the masses. Let's delve deeper into some of the topics with examples to provide a better understanding. Development Finance Institutions, DFIs, examples. A. Industrial Finance Corporation of India, IFCI. IFCI was the first DFI established in India in 1948. It played a crucial role in providing long-term finance to industrial projects and promoting industrial growth in the country. B. Small Industries Development Bank of India, SIDBI, established in 1990, focuses on financing and promoting small-scale industries and supporting their growth and development. C. Industrial Development Bank of India, IDBI. IDBI was set up in 1964 to provide financial assistance to large industrial projects and played a significant role in financing industrial development in India. Nationalization of banks example. In 1969, the Indian government nationalized 14 major commercial banks to promote social control over the banking sector and expand banking services to rural and semi-urban areas. One of the prominent banks nationalized during this phase was Punjab National Bank, PNB. Non-performing assets, NPAs, example. During economic slowdowns or crises, the rate of NPAs tends to increase. For instance, in the aftermath of the global financial crisis of 2008, Indian banks witnessed a surge in NPAs due to the adverse economic conditions and business defaults. Non-banking financial companies, NBFCs, example. A. Bajaj Finance Limited. Bajaj Finance is one of the leading NBFCs in India, providing a wide range of financial products and services, including consumer loans, personal loans, and commercial lending. B. Mahindra & Mahindra Financial Services Limited. It is an NBFC that specializes in providing financial services to rural and semi-urban areas, supporting agricultural and rural development. Financial inclusion examples. A. Pradhan Mantri Jan Dhan Yojana, PMJD. Under this scheme, millions of bank accounts were opened for previously unbanked individuals, and more than 40 crore accounts were opened within a short period. B. Payment banks. Examples of payment banks in India include Paytm Payments Bank, Airtel Payments Bank, and Fino Payments Bank. These banks focus on providing digital payment and remittance services, especially to those without access to traditional banking services.